In this section, I want to try and impress upon you the importance of behavioural finance. That is, what we actually do with our money despite all the economic theory. If we are the rational beings that economic theory assumes, then we would all be doing the same thing, which clearly we are not. When 50 million Telstra shares change hands in a single day, it requires both buyers and sellers. Who made the right decision? If investment property is a guaranteed investment, why does anyone sell it? Put another way, it is what goes on inside your head that will determine the outcomes you enjoy during your life, not what economists predict. Let's begin with some data and then explore some possible interpretations. This chart shows the three primary stock market indices: industrials, resources, and the All Ordinaries. It is important to note that this chart shows only the price indices alone. I have ignored the 30 years of dividends that these companies have paid. Thus, this chart gives you some idea of the relative pecking order of these sectors. Resources at the bottom, industrials at the top, and the All Ordinaries somewhere in there. One cannot fail to note the impact of the recent resources boom. However, I would like to express now a perception of mine. In my understanding of history, virtually all mining booms and the inevitable euphoria associated with any boom end with an inevitable bust. So whilst I acknowledge the current commentary about this time being different, I do not believe that this boom will necessarily be any different to all those in the past. More importantly, the reason resources are at the bottom of the scale and industrials are at the top is because throughout history, digging stuff out of the ground has not created serious wealth. The real wealth has come from manufacturing, technological and intellectual inputs. It is these things that have added the most value and advanced the human race. So whilst in price terms alone, the Resources and All Ordinaries Index have returned about 10 times your money, the industrials have returned over 13 times your money. Let's now look at these same indices if we reinvest the 30 years of dividends. The Resources Index goes from 10 times to 25 times your money. This modest result is because, apart from a handful of notable exceptions, resource companies generally are rather poor dividend payers, if at all. In fact, I observe that most resource companies are bought and sold on the basis of benefiting from price fluctuations, not dividends. I remind viewers of what this activity is defined as. The All Ordinaries Index goes from approximately 10 times to 33 times your money, and the industrials goes from 13 to 56. Yes, 56 times your money. I observe from these two charts that the bulk of the return from industrials comes from the cash flow or income that they generate for investors, not from share price movements. Sadly, it is the price movements uppermost in people's minds, as they are reported ad nauseum every day, whilst dividends regrettably only see daylight twice a year. Despite their overriding importance, they get little coverage. I would now like to share some of my perceptions as a long-term investor. In this chart, we see the All Ordinaries Index valued once a month over 30 years. I think most would agree that despite the persistence of the gradient, it is the short-term ups and downs that make investing in shares such an emotional roller coaster. Now, changing people's perceptions requires that the neural pathways they have established are altered. And so, whilst observing exactly the same thing, we can arrive at a different conclusion. Perception is reality. To ensure the best possible take-up of these changes, I would like to become Prime Minister. Firstly, I will shut the stock exchange so that no one will be subjected to the daily barrage of useless information relating to share price changes. Secondly, at present, I think you will accept that there are only 2 days on which you actually know what your house is worth: the day you buy and the day you sell. This is not good enough. So I will replace this with an edict that requires all television stations to report house prices by running them across the top of your television screens 10 times a night. By the way, I will be making up your house prices every night using a random number generator, anything between 0 to 100 million. Now, having shut the stock exchange, I have a herd of commentators who desperately need a job. As a result, they will now be interviewing you daily on your street corners to find out how you feel about the fact that house prices in your street collapsed by 20% today. I will also invite a clever investment bank from the US to create the most toxic residential property derivatives ever invented. You will now be able to day trade residential property. I suspect that only 12 months of this activity will see many people becoming uncomfortable with the volatility and risks associated with property and begin seeking the safety of the share market. I will not accept that simply because your house is illiquid that it is riskless, nor will I accept that just because I can buy and sell a share such as Commonwealth Bank 100 times a day that it is risky. However, let's explore this concept a little further. As the stock market is the mechanism that provides the liquidity enabling us to exchange the ownership of companies for value in a regulated and orderly way, I acknowledge this, and as Prime Minister will therefore allow the market to open on 1 day a year. On that day, we can all complete our share trades and then settle down until next year. If you will accept this compromise, then the chart will now look like this. Are you more comfortable now that the market doesn't go up and down so much? Clearly, volatility is a major issue for many people, as it is the short-term ups and downs of the market that are focused on and create the uncertainty. In the example above, all I have done is restrict the valuation of the market to the 1 open day a year to alleviate the uncertainty. This substantially reduces short-term volatility, but at a price. If I auctioned your house every day for 3 months, I think you will agree that your house price will be more volatile than Commonwealth Bank, for example. Would it be a comfort or irritation to you to come home and find that the price of your house that day, Melbourne Cup Day, had fallen by 50%, as only 2 mostly disinterested people attended the auction? Volatility is a direct result of liquidity, that is, the ability to buy and sell shares hour by hour, but it does not represent risk. Conversely, the fact that your house is illiquid and therefore lacks price volatility doesn't make it riskless. In the mind game I have just played, I have taken away your liquidity. Hence, shares are no longer volatile. At the same time, I have given your house superficial liquidity. Hence, its price is now volatile. The choice is yours. No liquidity, no volatility. Liquidity and volatility. What's your perception? I am a relatively uncompromising investor and would like to share my perception of how the chart of the share market appears. As unusual as this appears, I will explain. I know how much I paid for my shares, and I know what they are worth now as they were all publicly auctioned today. The only difference is that I choose to ignore all the noise in between those two dates, just as you do with your house. That's fair, isn't it? Which, as a long-term investor, would you prefer? And before you answer, remember, whether you choose this chart or the earlier one, you still end up at exactly the same point after 30 years. More importantly for me as an investor is the fact that the only change is the gradient of that line, infinitesimally on a daily basis. To demonstrate, let's look at it again, but only once a year. This is what the chart looked like in 2006. And again in 2007. 2008 and 2009. In a few months I will update the chart again for 2010 and no doubt stress over the outcome. Continuing my comments about perception, I would like you to consider again this chart. The 1987 crash is quite apparent. Now, reconsider the chart and tell me if you can point out the 87 crash. Look carefully. Like everyone I ask, I know that you cannot point out the crash because there wasn't one. My perception is that the 87 crash actually didn't happen. Allow me to explain. Between October 1986 and October 1987, the index rose 100%. The market doubled in 12 months. It subsequently fell by 50%, which returned it to where it started. All that occurred was a period of irrational behaviour, which was followed by the inevitable, perfectly rational correction. I say rational because I simply do not believe that it is possible for the value of all Australian companies to double in a year. Note that I used the word value. Clearly, all that happened was the share prices doubled, but the value remained roughly where it should have been. It brings to mind the quote, "Most people know the price of everything and the value of nothing." I can think of no clearer example than this. Sadly for the stock market, this pattern of behaviour is repeated again and again. Any cursory reading of history will underline the often irrational ups and downs of the market in the short term. It has become the barometer of irrational sentiment, reflecting fear, greed and uncertainty. As such, it has considerable appeal to the media, often hungry for useless information. As a consequence, I have often exhorted audiences to heed the words of that famous Australian philosopher, Chopper Read, and to toughen up, princess.